Welcome to the deep dive. Today we are undertaking a massive mission, cutting through a stack of sources that make up, well, the ultimate comprehensive toolkit for the modern real estate investor.
Yeah, this is quite the collection.
It really is. And this isn't just a list of things to do. We are talking about pure investment strategy, the intricate mechanics of actually closing a deal, and maybe most importantly, the massive historical and economic forces that shape every single market decision you will ever make.
That context is key.
Our goal is to synthesize this incredibly wide-ranging material, from micro habits for personal persistence all the way up to the macro context of urban zoning, and position you to build sustainable, robust wealth through property. Okay, let's unpack this, because we really need to understand the whole ecosystem, not just like the front door of the property.
It's absolutely the right focus. We have to look beyond just a simple checklist.
Right.
Our sources consistently emphasize that real estate investing, well, it requires linking those granular financial models you use for a specific property.
Yeah, the spreadsheets.
To the larger environment you operate in. That means recognizing how foundational regulatory structures, like historical zoning policies, for instance, affect property availability, or how market sentiment, which gets quantified in metrics like the capitalization rate, defines whether your investment is seen as stable or maybe a bit risky.
So it's not just about the numbers on your deal.
Exactly.
Yeah.
It's about moving past the what and really understanding the why and the how the surrounding economy influences you, the individual investor.
Okay, let's start with the absolute foundation then. Your personal goals. Before you even look at a single piece of property, you have to know why you were buying it, right?
Absolutely fundamental.
The material identifies two core goals, and choosing one really dictates your entire strategy, from vetting tenants to managing your capital. So goal one is capital gains investing. This strategy is laser focused on appreciation.
Right. Buy low, sell high, basically.
Exactly. You aim to purchase a property, maybe fix it up, or maybe just rely on market momentum, and then sell it for significantly more than you paid. The timeline here tends to be shorter, or it's dictated by market cycles.
And your energy is focused differently.
Yeah, your energy is spent on identifying properties with high discount potential, or those immediate improvement opportunities, things you can change quickly.
And the necessary long-term counterpoint to that is goal two. Cash flow investing.
Okay.
The primary focus here shifts entirely. It's about generating a positive passive income stream every single month.
Predictable income?
Predictable. You want that rental revenue to reliably exceed all your operating costs. So taxes, insurance, maintenance, and of course the debt service.
Right, the mortgage payment.
This is the goal that generates predictable long-term income. It often prioritizes stability over trying to time those rapid market fluctuations.
Okay, so two very different paths. And what's immediately clear is how the structure of your financing dictates how these goals interact with actual wealth generation. Let's talk about the mechanics of debt and the often underestimated loan paydown factor.
Yes, the loan paydown factor. It truly is one of the quiet giants in real estate wealth accumulation. It's kind of hidden.
How so?
Well, every time you make a mortgage payment, a portion of that payment goes toward reducing the principal balance. Seems simple, right?
Yeah, standard amortization.
But this reduction, steadily and predictably, builds equity for you, even if the market value of the property stays completely flat.
Okay. So it's independent of market swings.
Exactly. It acts as a kind of forced, scheduled savings mechanism. Your tenant is essentially helping you pay down that debt and build your equity.
And this is where the discussion on financing gets really interesting, because that forced savings benefit, well, it's only realized when you actually use debt, isn't it?
That's the key.
If an investor pays all cash, they skip that entire wealth generator.
Exactly. If you buy a property outright with cash, you definitely maximize your immediate cash flow. That's the plus side.
Because no mortgage payment.
Right. You'd eliminate the principal and interest payment from your monthly expenses, so you keep a much higher percentage of the rental income. Sounds great.
For that,
You miss out on the leverage benefit of the loan paydown. And crucially, you miss out on leverage itself, the ability to control a large, valuable asset with a relatively small amount of your own capital. It's always a trade-off. Are you prioritizing higher immediate cash flow, or are you playing the longer game with leveraged forced equity growth via that debt repayment?
that really sets up the contrast between real estate and, say, purely passive investments, like buying index funds. We often hear that classic argument, from economists like Burton Malkiel.
The random walk down Wall Street idea?
Right. That For the average person, just buying and holding a broad index fund often outperforms actively managed funds, mostly because of high expenses and trading costs.
And that's the core thesis of passive stock investing. It requires minimal personal expertise, right? You just sort of ride the market wave.
Set it and forget it.
Pretty much. And the frictional costs of trading actively tend to erode your returns over time. But real estate, it flips that script completely.
How so?
The sources tell us that in property, the active strategy is the value generator. You have to bring specialized knowledge, negotiation skills, and a real execution strategy to maximize returns.
You can't just passively own it.
Not if you want to optimize, no. You are not buying a liquid share on an exchange. You are buying a physical asset that you can physically improve and actively manage. You have direct influence.
Which means that while passive stock investing rewards, maybe silence and low friction, real estate demands professional, engaged execution.
Yes.
It requires a specific kind of mindset, one that embraces the complexity inherent in managing a physical asset and, importantly, dealing with people, tenants, contractors, brokers.
It absolutely demands that you actively assemble the infrastructure, the team, the systems to execute your strategy effectively. You cannot just, press a button and walk away hoping for the best like you might with an index fund.
Oh.
So let's delve into that mindset piece a bit more. The sources really underline the behavioral aspects of investing. It's easy to look at successful investors and assume they took these massive, audacious actions.
Right, like one big risky bet paid off.
Exactly. But in reality, the pathway to massive success often lies in small, consistent improvements, incremental gains.
And here's where it gets really interesting. This is the concept of gradual evolution, as one source puts it. The math is just staggering.
It really is.
If you can simply improve your skills or your processes or your efficiency by just 1% each day for 1 year, just 1%, you end the year 37 times better than where you started.
37 times. It compounds incredibly quickly.
That tiny improvement, maybe it's just vetting tenant applications a little more thoroughly or refining your maintenance scheduling system, it compounds into this profound competitive advantage over time.
And conversely, if you let things slide by just 1% daily, you are nearly back to zero in a year.
Wow.
It speaks volumes about the necessity of having systems and just plain persistence, especially when you face the inevitable setbacks.
And setbacks are guaranteed, aren't they? Particularly in transactions. Real estate involves constant negotiation and sales. You're selling a house, sure, but you're also selling yourself to a lender or selling a lease to a tenant.
Absolutely. The research mentioned suggests that the average successful sale is often only made after the 5th or 6th customer refusal.
5 or 6 no's.
Yeah, you are going to hear no repeatedly in this business, whether it's from a bank, a seller, a potential partner, whoever. Investors simply must cultivate a deep belief in their own plan and that persistence. Otherwise, those first few refusals will prematurely terminate what could have been a perfectly viable investment path. You just give up too soon.
Okay, so once that psychological foundation is set, the persistence, the 1% improvements you need to build the practical foundation, the essential team. This isn't a DIY project, is it?
Definitely not, especially if you want to scale or tackle complex deals. And your team structure will directly support your ability to achieve those 1% daily improvements we talked about.
Makes sense. Who's typically on this team?
Well, a robust team usually includes highly specialized professionals. You'll need real estate brokers, appraisers, accountants, specifically CPAs, ideally, and attorneys.
And the broker seems fundamental.
The broker is fundamentally important, yes. They are essentially the investor's eyes and ears on the ground.
Local knowledge.
Exactly. They know the local market trends, the off-market patterns, and often they have the earliest tips on potential deals that haven't hit the wider market yet. Their local expertise is just invaluable for accurate underwriting, knowing what things really rent for or sell for.
But we really need to stress the importance of avoiding conflicts and vetting expertise. The sources are crystal clear on this.
Oh, absolutely critical.
You must thoroughly vet every advisor to ensure they specialize in the specific type of real estate you are investing in.
Can't emphasize that enough.
Yeah.
If you are buying multifamily units, your broker needs to be a multifamily specialist, not just a residential agent who's, learning the ropes on your timeline and your dime.
Right. And that vetting extends to the legal and financial folks, too.
Absolutely. For the attorney, they need deep experience in local jurisdiction law. Things like contract drafting, sure, but also dispute resolution, eviction processes, and especially local zoning nuances that could completely trip up a deal unexpectedly.
And the accountant. The CPA.
Their expertise isn't just filing taxes at the end of the year. It's about active tax minimization throughout the year.
Strategy.
Yes, strategy. They help you navigate the really unique tax advantages of property ownership, like maximizing deductions for operating expenses, depreciation strategies, understanding capital expenditure rules versus repairs, and just organizing your books so you don't overpay the IRS.
Yeah, I've had real estate tax benefits are significant.
They can be huge. But if your CPA doesn't specialize in real estate, you could easily be leaving tens of thousands of dollars on the table every single year without even realizing it.
Wow. Okay, so competence over connection. That focus is also critical when bringing on partners, right? It's tempting to include friends or family.
Very tempting. And sometimes it works. But the advice is clear. Competence must come first. The financial stakes are just too high to allow unqualified individuals onto the core investment team, regardless of your personal relationship. It can strain both the investment and the relationship.
That becomes even more critical when we talk about passive investment vehicles like syndications and sponsors.
Yes, because your reliance on others is magnified there. In a syndication, you're pooling your capital with other investors, usually to purchase a larger commercial asset, an apartment complex, a shopping center, something like that.
Right.
And the sources argue pretty compellingly that the quality and integrity of the sponsor, that's the person or the firm managing the whole deal, can actually be more important than the property itself.
More important than the building, really.
It sounds counterintuitive, but think about it. When you invest in a syndication, you are typically buying a share of an LLC or a limited partnership that owns the asset. You don't directly own the property.
Okay.
And crucially, you often have no direct ability to foreclose if things go wrong or to control the day-to-day operations. You're relying entirely on the sponsor.
That distinction, no direct control, no direct property security, makes the relationship with that sponsor absolutely paramount then. So what specific leverage does a good sponsor provide that a bad one completely lacks?
A good sponsor provides leverage through, well, knowledge, certainly, but also financing power and capital resilience.
Resilience.
Yeah, think about it. If the market shifts unexpectedly, or the property needs a huge capital injection, say, a new roof, years earlier than planned, a quality sponsor can leverage their established relationships with lenders for better terms, or they can quickly raise additional capital from their existing network of investors. They have options.
And a poor sponsor.
Poor sponsor. Lacking that experience, those relationships, that resilience, they might just watch the deal spiral downwards. Or worse, declare bankruptcy, potentially wiping out the investors.
Ouch.
Your primary recourse as an investor relies heavily on the original legal agreement you signed and, importantly, the sponsor's track record and reputation, which just emphasizes the need for exhaustive due diligence on the sponsor's history and capabilities, not just the property's pretty pro forma numbers.
Okay, so now that we have the right team in place, hopefully, and the right mindset persistence, 1% improvement, let's look at the actual deal analysis. How do we move from philosophical strategy to, hard numbers and finding a good property? The price paid for any piece of real estate seems multifaceted.
It really is. The analysis process requires you, the investor, to look beyond just the headline, asking price, and consider 5 key factors that ultimately determine the price you're willing to pay.
Okay, what are they?
It includes 1, the discount required. Are you getting it significantly below what similar properties are selling for? Is there an immediate equity capture?
Makes sense. 2.
2, the cash flow expected. How much positive monthly income will realistically generate after all expenses and debt?
Crucial for buy and hold. 3.
3, the appreciation hoped for. This is your bet on the market, right?
Okay.
How much do you expect the property value itself to increase over your holding period?
Okay.
4,
The hassle involved.
Yeah.
How much time, energy, and stress will tenant management, repairs, and general oversight take? Is it a high-maintenance property or tenant-based?
good point. And 5,
And 5, liquidity. How quickly and easily can you realistically sell this specific asset if you need to get your capital out? Some properties are much easier to sell than others. Right. And different investment goals will weight these factors differently, won't they?
exactly. A flipper's going to prioritize that discount and maybe short-term appreciation potential.
Get in, fix, get out.
Right. While a long-term buy and hold investor will probably prioritize the expected cash flow and try to minimize that hassle factor. Stability over speed.
Okay. And this leads us to the actual valuation strategy. The ideal investment property, according to the research, is generally found where?
Generally, it's found at the middle or, more often, the lower end of the value spectrum for a specific neighborhood.
The worst house on the best street idea.
Sort of, yeah. Or at least not the best house. The idea is to buy a property with potential in a desirable area. You need to assess comparable sales values, comps, comparable rents in the area, and really focus on the cosmetic state.
Things you can fix easily.
Exactly. Things that are easily fixed for aesthetic appeal, but yield a significant return on investment. Paint, flooring, landscaping, fixtures. Stuff that looks bad, but isn't structurally catastrophic.
Now, to quickly filter through potentially dozens of properties, investors need some kind of shorthand, some underwriting rules of thumb. Let's talk about a popular tool for quickly estimating viability, the 50% rule.
Ah, the 50% rule. It's a really useful, rapid filter. It's designed to save you time before you dive into deep, detailed due diligence on every single property.
Okay, how does it work?
It suggests that, broadly speaking, a rental property's operating expenses, and this includes everything except the mortgage principal and interest payment, P&I, tend to be about 50% of the total gross rental income.
So half the rent goes to expenses, roughly.
Roughly. So, simple example.
Yeah.
If a property brings in $4,000 a month in gross rent, you can quickly estimate that about $2,000 will go towards those operating expenses. Property taxes, insurance, utilities the landlord pays, maintenance reserves, vacancy reserves, property management fees, if any. The remaining $2,000 must then cover the mortgage principal and interest payment. If your estimated P&I is less than $2,000, then you might have a viable cash-flowing property worth investigating further. If the P&I is more than $2,000, it probably won't cash flow based on this rule of thumb, and you can maybe move on to the next one quickly.
That's a great initial screen. Saves a lot of time digging into properties that just won't work financially. But the truly successful, millionaire investors often secure deals that require a level of financial creativity beyond just getting a standard 30-year fixed-rate mortgage, right?
Oh, absolutely. They use all the tools available in the toolbox.
Which brings us to some creative financing options.
Yeah, what are some examples?
Well, the sources list several advanced techniques used maybe when traditional banks are hesitant or when the seller has specific needs that allow for creativity. Take wraps, for instance, or wraparound mortgages.
Wraps, how does that work? This is where the seller essentially finances the difference between the sale price and the buyer's new loan, effectively wrapping the buyer's new debt around the seller's existing mortgage, which stays in place.
Interesting. Why would a seller do that?
The seller might benefit by earning a higher interest rate on the wrap portion than they could get elsewhere, maybe turn passive equity into an income stream. And the buyer benefits because they might need less capital up front, or maybe it simplifies the transaction if the seller's existing loan has a really great rate.
Okay. And what about a private second? That sounds inherently riskier, maybe.
It certainly can be, yes, but it solves a very common problem for investors, coming up with a down payment.
Ah, okay.
A private second is simply a second mortgage loan, but it's typically sourced from a private lender, often another individual investor, maybe a small specialized fund, specifically to cover all or part of the down payment needed for the primary mortgage loan from the bank.
So you can buy it with less cash out of pocket.
Exactly. It allows the buyer to close the deal with minimal personal cash invested, leveraging the asset very highly. The trade-off, of course, is that you'll be paying a much higher interest rate and often faster repayment terms on that second loan.
Ah.
It eats into cash flow but gets you into the deal.
Got it. And we also have things like lease options, which are essentially rent-to-own agreements.
Right, gives the tenant the option to buy later.
And, as we discussed earlier, syndications for pooling capital for larger deals. So once the financing puzzle is potentially solved, the real due diligence starts. And this is where that crucial distinction between inspections versus contractors comes into play. You mentioned this earlier.
Yes, it's really important. While you should absolutely bring your trusted contractor through a property you're serious about to estimate repair costs.
Get actual quotes.
Yes, get real numbers for your budget.
But the sources strongly emphasize the necessity of hiring an independent third-party professional inspector for the official inspection during your contingency period.
Why the distinction? Why not just use the contractor? Well, the potential conflict of interest is the first most obvious reason. The inspector doesn't stand a profit from finding more things to repair. Their job is just to report objectively.
Okay, independence.
But maybe more critically, the training is fundamentally different. A contractor is trained primarily to fix symptoms and estimate material and labor costs. They know how to fix the leaky pipe.
Right.
An inspector, on the other hand, is trained to spot the source of the problem. If a wall has a crack, The inspector's job is to diagnose why it cracked. Is it normal settlement? Is it ongoing water damage from a hidden leak? Or is it a serious structural foundation failure? They're looking for the root cause.
Which is vital knowledge for a long-term investor's capital budget and risk assessment.
Absolutely vital. Knowing the why helps you predict future costs much more accurately.
Okay. Finally, in this mechanics section, we have to protect that massive transaction through the title process. Investors sometimes treat title insurance as just this automatic safeguard, like a checkbox, but the sources indicate you still need vigilance.
That's right. The process starts with receiving the preliminary title report, or prelim. This document is not the final insurance policy itself.
What is it then?
It is the document where the title company informs you, the buyer, exactly what claims, lands, easements, or other encumbrances they have found in the public record, and critically, which of those they are willing to insure against.
Ah, so it lists exclusions.
Precisely. It lists the exceptions of the things the title company will not cover in the final policy. You absolutely must review this report carefully, perhaps with your attorney, because the final title policy will include all those risks the title company has explicitly refused to insure against.
So if there's, say, a boundary dispute mentioned as an exception, and that issue ends up costing you money later,
Your title insurance policy will offer zero protection for that specific issue. It was excluded. You need to identify those excluded risks before closing the deal and decide if you can live with them, negotiate to resolve them, or potentially walk away from the transaction if the risk is too great. Don't just file the prelim away unread.
okay, let's fast forward. The papers are signed, the deal is closed, congratulations, you own the property. Now the work shifts to maximizing the asset's performance, right? And the fastest way to boost both cash flow and equity isn't just waiting for the market to go up, it's through intentional improvement, what the sources call forced appreciation.
Exactly. Forced appreciation means you are actively creating value through immediate, smart improvements, rather than just passively hoping the market lifts your boat.
And a really compelling example provided is converting, say, a two-bedroom home into a three-bedroom home if the floor plan reasonably supports it.
That's a classic value add. That structural change can immediately attract a broader pool of potential tenants or buyers. It often increases the maximum achievable rent by potentially hundreds of dollars per month,
Significant cash flow bump.
and simultaneously adds tens of thousands of dollars in underlying equity value that you can realize almost immediately through, say, a cash-out refinancing event, pulling some of your initial investment back out.
And when you are calculating the return on that kind of investment, say adding a bedroom, remember that money spent on proper presentation and fixing deferred maintenance is generally an investment that tends to return handsomely, doesn't it?
Oh, absolutely. When you're tackling renovation and costs, fixing those broken or worn-out items now is almost always cheaper than the hit you'll take later.
How so?
Well, either through a lowered sales price because the property shows poorly, or through concessions you'll inevitably have to make at closing once a buyer's inspector finds all those deferred issues. Better to fix it proactively on your terms and budget.
Makes sense. And for budgeting those bigger ticket items, especially things on the exterior, knowing the typical material life expectancy seems vital for long-term financial planning.
It's crucial for forecasting your capital reserves accurately. For instance, knowing that typical wood or aluminum siding might last 20 to 30 years gives you a pretty clear timeline for when a major replacement cost needs to be factored into your long-term financial plan.
So you're not surprised by a huge bill.
Exactly. Vinyl siding might offer a slightly longer lifespan, maybe stretching to 20 to 40 years depending on quality and climate. Understanding these kinds of replacement cycles allows a serious investor to accurately budget for capital expenditures, ensuring they have the reserves set aside and aren't caught off guard by a sudden five-figure bill for a new roof or siding job.
Okay, let's move indoors now and talk about presentation, whether you're ultimately selling the property or renting it out. This is the art of staging, which seems to go way beyond just basic cleaning.
It really does.
Yeah.
Staging is about creating an aspirational, yet neutral blank slate for the potential resident or buyer. You want them to easily picture their life in that space.
And the core rule here seems to be depersonalization and maximizing the sense of space.
That's it, exactly. Staging requires systematically removing anything that's too, well, personal family photos, obviously, but also anything potentially polarizing like overt political or religious items, or even just overly specific or cute decor.
Keep it neutral.
Keep it neutral. Focus on uncluttering, which really means pre-packing items you won't need immediately, and ensuring a really good visual flow through the space. Don't block pathways.
And some great aesthetic tips were mentioned, like using large mirrors.
Yes, mirrors are fantastic. They reflect light and can make rooms feel substantially larger and brighter. Also, incorporating pictures or art that use deep perspective can visually add depth and space, making a small room feel less confined.
But the staging approach apparently needs to be nuanced based on the target demographic you're trying to attract. Our sources provide some fascinating generational staging nuances.
Yeah, this was interesting. It illustrates how subtle changes in decor can really affect perception and appeal differently to various age groups or lifestyle segments.
So, for instance, if you are targeting baby boomers,
The style should generally lean towards sophisticated and classic. They tend to respond well to elements like maybe a comfortable chaise lounge, traditional lighting like Chinese export porcelain lamps, and interestingly, the sources note they explicitly dislike overly graphic or trendy throw pillows.
okay, good to know. What about Jonesers, that group between boomers and Gen X?
Jonesers, often characterized by embracing more contemporary styles, apparently do like those graphic throw pillows. They also respond well to things like large contemporary mirrors, maybe over a bureau, to open up the space visually.
And Gen Xers?
Gen Xers, according to this, tend to prefer a truly minimalist, uncluttered feel. Think clear bedside tables, neutral artwork,
Mm,
and they specifically seem to avoid action-filled or visually loud pictures that might feel chaotic.
wow.
These might seem like minor details, right? But they help enhance that idealized vision of life in that home for the specific person you're trying to attract. It can accelerate the tenant's or buyer's emotional connection to the property.
Makes sense. Okay, so once that property is acquired, maybe renovated, staged beautifully, and finally rented out, the long-term success really hinges on professional operations, treating the venture like a true enterprise, the business of landlording.
This is absolutely fundamental. You can have a great property, but if you manage it poorly, it can turn into a nightmare.
And the core principle seems to be discipline. You have to establish clear, firm, and consistently applied policies for everything: collecting rent, handling maintenance requests, enforcing lease terms, issuing legal notices when necessary.
Consistency is key.
Yeah,
And central to that professionalism is meticulous, accurate bookkeeping,
which we touched on earlier with the CPA.
right? And bookkeeping isn't just about staying organized, though that's important. It's a critical tool for tax minimization.
How so, again?
Well, your detailed books allow you to accurately track and, importantly, maximize all the eligible deductions you're entitled to as a property owner: mortgage interest, property taxes, insurance, repairs, utilities, travel for property management, home office expenses related to the property. The list goes on.
Things you might forget if you're not tracking.
Exactly. Better bookkeeping leads directly to lower taxes because, as we said, real estate is one of the most tax-advantaged assets available. But the IRS requires proof. If you don't document those expenses accurately and contemporaneously, you will inevitably miss out on substantial, perfectly legal write-offs. You're just giving money away.
Okay. And finally, under management, we have to discuss risk mitigation, liability, and habitability. Being a landlord isn't without risks.
Definitely not.
Yeah.
Landlords face significant liability risks if they neglect the property or fail to provide safe conditions.
Where does that risk primarily stem from?
It can stem from many things: poorly maintained locks leading to a break-in, broken stairs causing an injury, delays in making essential repairs like fixing a heater in winter, or even failing to adequately address ongoing criminal activity occurring on the premises, if you're aware of it.
And there's a legal standard here.
Yes, the law in most places enforces an implied warranty of habitability. This basically means you, as the landlord, have a legal obligation to provide and maintain a property that is clean, decent, and safe for human habitation.
So doing the right thing morally is also legally required.
Pretty much. Conscientiously tending to the property, responding promptly to repair requests, ensuring basic security measures are functional. It fulfills this legal obligation, sure, but it also reduces tenant turnover, attracts better tenants, and ultimately reinforces the desirability and value of your property and even the surrounding neighborhood. It's just good business.
Okay, we've covered a lot of ground. Building the strategy, assembling the team, mastering the nuts and bolts of the deal and management. But every single one of those decisions, where to invest, what price makes sense, who you're likely to rent to, is filtered through these massive external forces. We have to zoom out now and try to understand the historical and economic context that really determines whether your chosen market is likely to be expanding or maybe stagnating.
This is crucial context that many investors overlook. We often start with the historical shift to suburbia. The way American cities are structured today, This dispersed car-centric model is actually a relatively recent phenomenon in the grand scheme of human history.
It represents a fundamental redefinition of settlement patterns, doesn't it? Moving away from the dense, walkable cities that existed for millennia.
Completely. The shift gained serious momentum aggressively in the late 19th and early 20th centuries. Initial suburban developments, often fueled by sort of romanticized imagery of country life close to the city.
The best of both worlds idea.
Right. They scattered a few houses in the midst of open spaces, the precise opposite of the historical, dense walking city. And by the 1870s, the suburb was already being hailed by some as the city's crowning glory.
What really enabled that physical spread?
The key technological catalyst, according to the sources, was the electric streetcar.
Mass transit.
Mass transit, exactly. The tracks radiated outward from the central business districts, and they dramatically cut commute times. People could travel maybe 4 times faster than using the previous horse-drawn systems.
Opens up a lot more land.
It opened up a vast ring of newly accessible land around the old city core. This allowed a new city, increasingly segregated by class and economic function, to emerge. This new, spread-out city encompassed maybe 3 times the territory of the dense old city center.
And this spatial separation fundamentally changed who lived where and how cities generated wealth, didn't it?
Absolutely. It led to increasing separation of workplaces from residences and separation of different income groups into different neighborhoods.
And that spatial individualism wasn't just accidental, was it? It was kind of locked in by policy, specifically through the invention of modern zoning. Let's look at zoning's intent and impact.
This is a really critical piece. Modern zoning in the U.S., as it developed in the early 20th century, was consciously invented and implemented, according to these sources, to justify government action primarily as a means of defending and elevating private property values.
So protecting existing owners' investments was a primary goal.
It seems to have been the primary goal, advancing a kind of economic individualism through land use controls. Early advocates focused squarely on the financial benefits that private owners could extract from having the government regulate what could be built nearby.
And a major component of U.S. zoning that really reinforced this spatial individualism was the creation of the exclusive single-family district.
Yes, this was a uniquely American innovation at the time. It meant that certain large areas were legally shielded from the introduction of almost anything other than detached single-family homes. No apartments, no corner stores, no multifamily residences allowed.
And that became the standard blueprint.
It became the dominant blueprint for American urban and suburban expansion throughout the 20th century, creating a development pattern that's still radically different from how many other industrializing societies developed their cities, which often remained much denser and more mixed use.
Okay, so this foundational historical choice to prioritize existing private property value, often by limiting density, has profound consequences today, doesn't it? Especially in high-growth, so-called superstar cities.
Absolutely. This is where we see the urban crisis and inequality sharpen dramatically.
How does that play out?
Well, on the one hand, the clustering of talent in these dense metros, think New York, San Francisco, Boston, Seattle, is undeniably the engine of our modern knowledge economy. It drives innovation and growth,
No.
but it also drives profound inequality, largely because the resulting housing scarcity, exacerbated by those restrictive zoning rules, is so extreme. Economic theory suggests everyone should earn higher wages in these dense, productive cities.
And they do, nominally.
They do earn higher nominal wages, yes.
Right.
But the sources show a really startling pattern when you account for housing costs. Professionals and knowledge workers generally thrive because their wage increases usually outpace even the very high housing costs. They come out ahead.
But what about blue-collar workers, service workers, the people needed to make those cities function?
That's the problem. They are often substantially worse off financially in those same large, dense, high-wage metros after they pay for housing.
Worse off than where?
Worse off than their counterparts doing similar jobs in lower-cost, less restrictive areas. They earn more on paper in the superstar city, but they spend such a disproportionately high percentage of their income on rent or mortgage that they actually have less disposable income left over.
Wow. So the high wages are basically eaten up and then some by housing costs for lower and middle earners?
For many, yes. Which highlights this critical systemic issue, is the regulatory structure, originally designed maybe to protect property values, now simultaneously hindering economic mobility and opportunity for those without existing capital or high earning potential.
And the research seems to confirm that zoning acts as an economic restrictor on a larger scale, too.
It does. The evidence suggests that zoning and other stringent land use regulations, things like mandatory minimum lot sizes, restrictive height limits, complex approval processes, parking minimums, anti-ADU, accessory dwelling unit policies, that severely limit housing supply, have a measurable negative economic impact.
How big?
One study estimated these regulations cost the U.S. economy somewhere between $1.4 trillion and $2 trillion in potential GDP gains over about 4.5 decades, simply by preventing people from moving to areas with higher productivity and opportunity.
Because they couldn't afford housing there.
Precisely. And the combination of already high land values in desirable cities, plus these high regulatory barriers and construction costs, means that any new construction that does happen is overwhelmingly skewed toward high-end luxury housing.
Because that's the only thing that pencils out financially for developers.
Exactly. It makes building truly affordable or even middle-income housing fundamentally difficult, if not impossible, for the private market to create at scale in these key cities under current rules.
So, in essence, the rules that arguably help keep established homeowners' property values elevated are the very same rules that might be locking out and economically disadvantaging the next generation of potential residents, renters, and essential service workers.
That seems to be the core structural contradiction at the heart of the current housing market in many desirable areas. Every investor operating today needs to understand this deep-seated context. It shapes everything.
Wow. We've really taken quite a journey today. We covered the foundational goals of real estate investing, the absolute need for a disciplined, persistent mindset, the practical hands-on steps of evaluating, financing, and closing a deal, managing the asset, and finally zooming way out to see the massive urban and regulatory forces that contextualize every single market decision you make.
It's a lot to synthesize, but this deep dive really does provide essential knowledge for anyone looking to build sustainable, potentially tax-efficient wealth through property. And remember, investment success isn't just about finding a cheap deal or running the numbers correctly.
Right.
It also requires understanding market sentiment. A tool like the capitalization rate, for example, the cap rate, it's not merely a financial calculation of income versus value. It's really a quantification of how the market collectively views and values that specific income stream at that specific moment in time.
So what does a low or high cap rate signal?
Well, generally a low cap rate implies the market perceives that income stream is very safe, stable, and perhaps having good growth potential. They're willing to pay a high price for it. Conversely, a high cap rate might signal the market perceives higher risk associated with achieving that income stream, or maybe limited growth prospects. Understanding this market valuation language is just as crucial as mastering the underlying economic and social environment you are investing within. You need both micro and macro understanding.
Absolutely. So while we discussed all the intentional steps needed for success, that 1% daily improvement, the detailed inspection, the careful staging, remember that property markets are constantly being shaped and constrained by these historical structures, like zoning originally designed, perhaps, to defend private value and scatter houses across open space structures that predate your investment by decades or even a century. So the final thought to leave you with is this. How will you adjust your strategy to navigate markets whose foundational rules were set long before you entered the game and perhaps were not set up in a way that favors growth, density, or equity for everyone? That's your deep dive homework.